Yo, people. Okay, yeah, day 43. Another day, another dollar. Today, I'm not gonna lie, I was sleeping. I took a nap at 8, fell asleep for like an hour or 2 hours. It was gonna be a long stream, but you can tell by my yawn, forgive me. You can tell by my it was meant to be, live for an hour, like 3 hours, but I knew I wasn't gonna be awake. So here we are. Hopefully we will probably try to do something tonight. We'll see. Nevertheless, you know the structure already. We're going to go through the website. We're then going to go to summarize what we learned for episode 6. And then from episode 6, we can then go in straight into the episode 7, which is an hour long. We should be able to, I don't know why it's not in the format of the playlist. You search it. Let's go 2022. We should be able to do more, like at least 7 and 8, because we do watch it on a faster speed than 1x. So we should be able to listen to it fine. Wait. I just realized something. My desktop audio was muted. So it has all this time. Wait, there's no way, right? There's no way. Oh my gosh. It's been on mute. Oh, Lord have mercy. Oh, my goodness. Anyway, nothing we can do about that. That's hilariously not funny. Nevertheless, that's been sorted. Let me just double check it's working now. Okay, we'll check it later. So yeah, we're going to go through episode 6, then we're going to move on to episode 7. So we're going to start off with the website. If you guys don't know, we have a new website called @ch.com, which is a trading journal. This will help you 100%. It is amazing. I made it mainly because I needed the help. I really wanted to find a journal that could meet my needs. I think this meets a lot of what people are looking for. It has so many features and it's free to try out, free to use at the beginning. You have, I think, up to 50 trades for the free tier. And then if you create an account and you sign up for premium, which is $9.99 a month, you're then able to obviously have the access to all the features, unlimited cap, or to be fair, not everything's unlimited, but you have unlimited log trades and you have the access to the scanner and the AI agent. So yeah, you get to log the trades here. You get to filter all of your trades. You can sort them by the wins only, the times when you broke your rules, and you can see how this stats page up here or stats diagram up here changes every time you select one of the filters. That's because it shows you the total trade win rate, the profit loss factor, all of these types of things, whilst you are, of course, filtering the table. This is up to you. The calendar is also another view which a lot of people will like, where it shows you week by week summary of your day by day calendar trades. It's kind of like an activity heat map, but it gives you a bit more detail, and you can sort it by quarterly, by yearly, and then it will obviously be something that you can see as you go along. You can also have some filters as well that are also available here. Then you have the analytics page, which includes, like I said, the activity heat map, which I was referring to earlier, of how many times you trade. Green, obviously, the greener it is, the more profit. The redder it is, the stronger the loss. And then you also have access to some diagrams that can give you some really impactful information. For example, here you can see the profit and loss by the pair. So if you're trading Forex like myself, you can then see which pairs you do the best in if you trade more than one pair. You can also do this on the back testing thing where this is all strategies or a specific account. We are currently updating the website. We're adding changes daily, but we just need to make sure everything's working, that we don't upload a bugged website. We're going to clean up the UI a little bit here and there, and little things will help. When you get the premium or the pro, you have access to AI trading agent, which is where you can actually click on one of these and it'll give you a report about your logged trades. It'll tell you what you're good at. It'll tell you how to improve, depending, of course, what you put. And you can also ask customizable questions in the search box. This is 50 minutes messages per day for the premium features, which still should be enough. Just to help cap people from just spamming it. since it is a paid feature. And here we have the access to cloud storage to download it to your own Google Sheet document. You can also download the CSV to export it somewhere else. You have the ability to get in touch with me directly if there's a issue with a bug, feature requests, general feedback, whatever it may be. You can get that straight to me. And of course, you can feature ideas over here, and then it will be voted on the community. Like I said, this is being daily updated. It's just that I would ideally aim to push the updates publicly every week, once a week, because I'm going to be using it as well. So that's why I believe I can keep that up for a while. And this is going to be our journal that I think will change your trading. Okay, now that's out the way. We're going to go over what we learned in episode 6. Episode 6. So let's start from here. So we start off with this diagram over here. And essentially, we were going over these two images were together. And we can see here how smart money represents institutions, it represents banks, hedge funds, and essentially traders that have more knowledge and greater skill sets, and of course greater capital in the markets as evidence to their success, compared to speculative uninformed money, which is representing retail traders, who are traders like you and I, however traders without the information, because it's possible to become a retail trader by avenue, but you have by skill smart money concepts. What does that mean? That means you're technically a part of this bubble here rather than here. This is the majority of traders that are losing money constantly, that have similar ideas which will lead them all into the same path of losing money. Smart money, however, has a different understanding of the markets, looks at how to take this money and put it into their pockets, and that's why we're trying to analyze the footprints of the smart money to then follow in their footsteps rather than being the ones or the target for smart money. This is how we internalize price delivery. We have, let me see if I can make this a little bit larger without affecting the. Okay, cool. We have things like this where we do not trade pattern for pattern's sake. Why is that the key? Because we wrote down here one of the most popular sayings, which I even used to be a believer in, and I still technically am to a degree, but with great understanding, is that the trend is your friend, and that is the saying that's so popular, that you always trade with the trend, which is true to an extent, but the trend is your friend until it's at the end of the trend. Then you're no longer friends, right? Because then there's a reversal happening and you're trading with the trend, but then there's a reversal set up, whatever it may be. So every rule, there's an exception. It's basically the point that's being made. So I always say we do not trade patterns for pattern's sake. Patterns could be things like this. We don't trade the trend just because it's a trend, because it's, at some point the trend will be violated. Sometimes it can even be violated in the sense of a liquidity sweep and then return back to the trend. So we have to be careful. And no matter what strategy we have to look at it from a different standpoint or perspective. We don't trade indicators. That's just a flat rule. We don't use them. Now, when I say indicators, I'm talking about tools to help with your entry, not tools that help you with information. Tools such as RSI, Bollinger Bands, Elliott Wave, anything to do with support and resistance, supply and demand, we no longer believe in. So we look to enter longs where retail sells, which is essentially when this type of money is selling, we want to be here buying alongside the smart money concept. When retail is selling, of course, vice versa, we want to be buying. We anticipate price seeking opposing liquidity. So we look at the markets in the terms of liquidity. Liquidity is areas of market orders or market stops. Buy stops and sell stops. That's what we're looking at. And we're looking for the deliverance of price from one area of liquidity to another area of liquidity through liquidity. We're going to go too much in detail what that means because we've kind of been covering it. And we see time differently. As a smart money concept, time means differently to a smart money trader than it does to a speculative trader. To a speculative trader, time probably is just that, oh, hey, I wake up in the morning and wake up early when market opens, I'm a trade. But a smart money concept person would understand that time is effective to Judas swings, to fake outs. Time is effective to when the markets will move. Time is effective to when we should be looking for expected deliverance or expected entry points. Time is where we also do not enter. We have rules of when we don't enter, and we have reasonings as to why. Time is a lot more effective and more prominent to a smart money concept trader than it is to a person that's more speculative. We then went over their fair value gap, which is this bullish version and bearish example here, bearish and then bullish example over here. It's a 3 candlestick formation. And essentially that space is evidence that price that is only being offered for that small moment to a sell side. And the best example I heard was in episode 6 where it talked about painting. When you have a roller and you're painting a wall and you want to have stuff from the top down, it's a long wall, or tall wall rather. You will put paint on the roller and you'll roll it down. As you're rolling it down, you'll realize the paint will slowly start to show gaps and pores. Why? Because the paint's running out. And what that means is that the only best way to kind of fill those gaps, which is what we call fair value gaps, is to go back in that direction, back over where you came from, back to that same point, which is a concept of the fair value gap, that once you create this imbalance, price will eventually come back to it, which is what stems and supplies our entry model. That is inefficiency not being offered to buy side, which is the kind of what's going on and reason behind that in the market sense of things. Segueing us into the market structure shift. So the market structure shift is when market obviously has this pattern. This is the bullish example, bearish example. And essentially we are creating rules to the market structure shift that we will need an energetic displacement for us to classify as a market structure shift. And in that displacement range is where we look for the fair value gaps. We went through some examples. This was us starting on the 15-minute time frame at 8:30 a.m. and we had to look for areas of where we should be looking for to target buy side liquidity. And you can see around about 8, I think 8:30 was around here. We then come up, sweep the high, then we push to the downside. But even in this sweep, we then follow a fair value gap on the smaller time frame because this is 15-minute. We then pull back into the fair value gap and then we push to the downside breaking structure as well. We also break structure down here because these lows got taken out. So yeah, we move to the downside and then we continue moving to taking our sell side liquidity, and there's lows over here as well. So that's what we analyzed. We did this as a pause video, find it ourselves, and we were correct. So this is the same, I believe, chart on a smaller time frame, and we highlighted this red circle. I'm trying to find out why. I'm not too sure why there's a red circle, but if we look towards here, it might be incorrect. But over here, after we swept, we then see this fair value gap here, and price trades back up into it. You set your stop loss above that wick over here, or this top of this first candlestick contributed to fair value gap. The 1 minute of the same chart, you can see there's more opportunities here because there's a fair value gap here. We then push back up into that fair value gap, which could supply your first trade to the downside. And here is good because we went through an example that we don't trade, which is actually a part of this. So just before that red circle, you see right there, we actually do sweep above, which this is it zoomed in. We sweep just above, but why don't we take this? Well, one, it doesn't take out this low. Two, it's not displacement. And with those two things not being active, we cannot say that we're going to go down. So we wait, or we don't enter, in fact. And that's why we wait. This is an example of something we don't take. We don't have the displacement, or we don't have the fair value gap. So the trade's already invalidated. The second break is a likelihood of price going lower, but we still have to wait for price to have the fair value gap and the break of the market low. Once we have those two things, then we can start looking to enter. External liquidity is the lows outside of the range, which is what we're targeting. Internal liquidity is within those ranges that we are drawing for this purpose of our markup. So now we're going to segue that into episode 7. There wasn't any homework. So wait, I don't know why the audio is still not working. Hold on.
Hurdles.
There we go. So we're learning about daily buys and consolidation hurdles.
The daily chart for the NASDAQ. And if you're looking at trading view under the NASDAQ selection, so it's the continuous contract. That way it makes all the candles look nice and crisp and you don't see any spotting. So right away, if you're looking at this, you should see this run on price taking out buy side liquidity. So these relative equal highs here. Ran above it, then broke below, swing low, created what? Here what I got. Trades up into it. Now where's it going to trade to? This low to this high, midpoint. There's a gap right there. And you have the old low. Sell here, in here, or here. And it runs it out. Now, this is important. Obviously, it sounds like, well, you're cherry picking in the pack. Old moves. Okay, that's how you learn. But think about what's happened on the daily chart. We traded below this low. We've taken sell side liquidity out of the marketplace. So with that, it's likely to retrace back up into the range. What's the range? This high to that low. But look closer. See how we have this nice energetic run? How many down close candles we have here? 1, 2, 3, 4. A lot of movement there. So I'm looking at this high and this low. and I'm trying to get a range for where we are at present. So once the sell side was taken out here, it's likely to retrace back inside the range of this high and this low. We've seen it come all the way back up. It went to a premium market, which is above equilibrium here. And then we went down below to a discount, bounced off of the old low here. Then we consolidated around equilibrium. Now, when you have this condition, it can make it very difficult to get a true reading on bias. Okay, so there's times when even me as ICT, I don't have a good, clear read on what it is I'm looking for. So I have to demand more price action and more information, or intel as I like to call it, based on what the market's going to do right after the open at 9:30 in the morning, New York time. For disclosure, in my own paid membership, I mentioned to them that I felt that this was a likely area where they could probably take it down and sweep that area. Whether it goes lower or not, it's irrelevant. But where we were here to here, that's what I was expecting, some type of move last night for Tuesday's trading. Okay, so Tuesday's trading, the 8th of February, 2022, going into the marketplace, I was anticipating something that would be bearish. That's going to be useful to us when we go into lower time frame charts, because I'm going to show you what I had to deal with this morning and how I had to overcome that. And this is something that if you're using these concepts in practice with your demo account, you're going to have these same conundrums. And you have to find a way to overcome them, and I'm just going to suggest this to you here. But before we go into lower time frames, I'm going to teach bias, okay? So if we have this set up on a daily chart, market structure has a shift lower, driven to a fair value gap. Until we get down here and here, each day I'm anticipating lower prices. So my bias is bearish. Now, every single day is going to be a down close candle, but I'm going to hunt intraday price action with that in mind. If I'm going to take it long, it would be counter trend to that bias. My leverage is going to be dialed back. So let's assume for a moment that the account that I was trading would allow me to trade 10 contracts. 10 contracts would be the maximum I could trade. So if I'm trading with the bias, which would be bearish during the run from here to here and here, then I'm going to look to utilize the maximum leverage that I can have without over leveraging based on a fixed percentage basis. Like I like 3.5%. I'm not telling you to use 3.5%. You should be risking less than 1%, about 0.5% or 0.25%, because if you don't know what you're doing, there's no reason to be putting higher levels of risk behind a move if you don't know what it is you're doing. It's going to create toxic thinking, bad habits, and you're going to be afraid to execute based on the results you're getting. So you're going to be indifferent to the results. And that, in the beginning, is important by having a demo account using very, very low leverage, if not deleveraging. Okay, and I'll talk a little bit about that when we get into money management, but that's not this topic. So from this high down to that low, each day I'm going in with the expectation that it's going to likely set up a sell scenario where I can get short and hopefully buy back at a lower price. Count how many up days or green candles there are from this high and this high down to that low. 1, 2. Real important. So the delivery by the algorithms are spooling. That means prices expanding and going directionally one way. When that occurs, there's going to be times where you have an up close candle. That may be a day that you tried to go short and maybe you've lost. Okay, no big deal. Same thing going into the next day, going in for looking for shorts. Next day, same thing, same thing. And then here, it opens and trades down below the low and has a huge expansion move, and then comes back above, and that's it. It closes on the near high today, or midpoint of the body in this area here. Is there a lot of up close candles during that bias being bearish? No. You need to get over the concern about being right every single time. You need to put aside also the idea of perfection, because you're not going to have it perfect. You're not going to get in perfectly. You're not going to get out perfectly. You're not going to have the perfect amount of contracts. You're not going to have the perfect asset. In other words, you may be trading the NASDAQ and the E-mini S&P has a little bit better run and delivers a little bit more. Highly unlikely, but vice versa. You get what I'm saying. So you're always going to find reasons to be wrong. Embrace imperfection. Embrace the idea that you don't have to know everything. You don't have to be right. Okay, being right is not equivalent to being profitable. Very important factor there. So with bias, in short, you're looking at your daily chart to get a read on where it's likely to go to next. Where's the price going to draw? Is it going to draw higher to an old high? Is it going to draw down to an old low? And until it gets that high or low, you stay with that bias. Okay, so it's a quick down and dirty way of interpreting price action for daily bias.
Okay, let's summarize this really quickly. So the first thing I want to note is that we're talking from this high over here to this low over here. And essentially he's saying that within that, your bias is going to be bearish. Why? Because you're targeting this low over here, which is sell side liquidity on the daily. So here we have the leg move downwards. From the range high to low, we have a bearish bias because we are targeting the low, which is marked by sell side liquidity. Holy spelling. All right, liquidity. That's number one. Number two, what else he mentioned was that price is spooling. Whilst we're bearish, only two right, so those are the things that stood out to me. First thing is that on the daily time frame, we're looking to target this sell side liquidity, and we're obviously bearish. We also have the fact that we have a continuation of negative bearish candles, but there's only two of the candlesticks in this whole move that are bullish, meaning that even if I was to look for sales every day, first of all, just because you're looking to sell on a day where it's a bearish candle doesn't mean you'll make money, because you have stop loss, take profits, all of these types of things. But the idea, at least, is that whilst you are in this bearish move, you're more likely to win in taking sales than you are in taking buys. Not to say you can't take buys. So we're going to make that point about it's fine, but then we're also going to say that when we are in a bearish, when we have a bearish bias or whatever bias we may have, we're going to use this as an example since that's the image. When we have a bearish bias in this instance, we are going to be targeting sells over and over, which has already been made. I don't think it's actually been made, but we're going to say while we're also bearish. I think he did say something about you can enter buys, but what he was saying is that he's going to use the maximum risk that he's pre-allowed himself to use for the sells. So we'll be looking for to reach the source of liquidity during this movement. We can risk the most we have preset for our. That's what I gathered from that 7 minutes. Let's continue.
But the folks that I've taught that are hung up on daily bias, really what they're trying to say is, and this is exactly what they're getting at, but they can't either articulate or they just won't be honest with it, or me. What they want is, tell me how to get the high of the day when it's bearish and how to get out at the low and get all the move and never take a loss. And avoid when it's going to be a day that goes against me where I feel uncomfortable. Now, that might sound extreme, and maybe some of you that have issues with daily bias are thinking to yourself, that's not me. I just want to know when it's going to go up, when it's going to go down. I'm telling you, if you strip it down, that's what you're trying to do. You're trying to demand that I give you some magic bullet that's going to give you the absolute highest high and the lowest low on the bearish and bullish days. So that way, you're trading perfectly. I don't trade perfectly. No one trades perfectly. So you have to have this embracing of the gray area in the marketplace. That gray area is where things aren't always so clear. But because of experience you've had in the past, seeing things unfold the way they hopefully would if you've been trained properly.
I want to make a quick note of that because I really like that. I think it's very powerful that there's going to be a great area in the market and we are to embrace it. Because a lot of times when you're learning a new strategy or when you're learning a strategy in general or you're even using your own strategy, you expect it to always win, which is fine. I like the mindset of winning. At the same time, you can't beat yourself up about it unless there's a pattern, which is why we have the website at CH, because it reveals patterns to you. And then you can then determine if it's something that you want to accept in your strategy or if it's something that you can change, which is why there's so much going on with this website. Hold on, there's so much. I don't know, keep plugging it, but it's actually useful. So I don't have any shame. When you have all these trades, right? And you have tags, you have rules, you have direction, session, pair model, the day and time. You have all these things that you can filter your trade by. There's so many factors that could be contributing to your trade, or why it's winning, why it's losing. And if you can find out what it is by finding out the pattern that is essentially contributing to that, whether or not it is, but it's because you're reading it down, so you believe it is, you can then make a change. And that change is either, you know what? I realize that every sell I enter, look, if I had buys and longs, right? But as I said, sells and longs, and I had 1,000 trades, and half of them were longs, half of them were shorts. And every single long I took was a loss. Every single sell I took was a profit. What do you think I'm going to do? I'm going to stop entering longs. Or I'm going to say, you know what? Maybe it's the way I'm looking at the market. Let me invert it. Obviously, it's very unlikely you're going to get that over 1,000 trades, but I'm just saying as an example. And that's the whole purpose of this, that what he's saying there is that some of the things you're going to have to accept, some losses you're going to have to accept, because the market isn't always clear. And therefore, that always unclear moment may cause you to lose money. Of course, you can go on an amazing streak. You cannot lose for months, but you can't expect to always win because there's a lot of great areas in the market. So I want to summarize that and put that into the notes. So how am I going to write this? People are so weird. I like that unfailing accuracy.
Then there's nothing to fear. Even if you do it wrong and you have an adverse reaction or result to taking a trade using the logic that you're training with, there's no reason to be fearful, because one or two or maybe a small string of losing trades does not in any way, shape, or form diminish the effectiveness of a model if it's based on sound logic. So you're going to utilize the daily chart to determine whether or not the next candle is going to be likely bullish or bearish. Between this high here and the midpoint of this low high, I'm expecting down close candles. That would equate to a bearish bias. It doesn't mean that I can't take a long entry. It just means that if I do take a long entry intraday, I'm going to do it with far less leverage. And if I see a setup that's bearish, I'll use or consider using, not always, but I'll consider using my maximum risk, which is 4.5%. But I like to see trades that I feel comfortable with 3.5%. And until we get down to this low and underneath it, that means it's likely to reverse or consolidate. And we have a retracement back in. So once it starts doing this and it's hanging around equilibrium, it gets very difficult, even for me, to determine a bias. So what does that mean?
And that's also good to know. We can crop this actually. Doesn't really. So when price is the daily time frame. Let me actually make a note of that. There should be a way to bring it forward.
No trading? No. It just means that you have to rely on the smaller time frame intraday charts and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble and highs, running out old lows. So you're going to trade intraday volatility, running and just simply look for liquidity pools. It just means that you have to rely on the smaller time frame intraday charts and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble.
So we're gonna rely on intraday. What was it? Intraday.
And just simply look for it. Just so you're going to trade intraday volatility, the smaller time frame intraday charts, and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble and like a surgical strike. You take your handle.
Was there something you said specifically? I want.
It gets very difficult, even for me, to determine a bias. So what does that mean? No trading? No. It just means that you have to rely on the smaller time frame intraday charts and just simply look for liquidity pools. So you're going to trade intraday volatility, running old highs, running out old lows, being a lot more nimble and like a surgical strike. You take your handles or your points you're trying to get out of the marketplace and then run. You don't try to overstay your welcome. So let's go down to a lower time frame. All right, so we have the 15-minute time frame.
Okay, I like that. So when price is consolidating, we need to rely on intraday volatility, trade low time frame liquidity, and have a surgical strike with our trades, which means that we stay in for the precise amount of time. So another way of wording that would be to have disciplined targets and stick to them. And when saying brackets, do not overstay your welcome. So it doesn't stop us from trading. It just changes kind of our posture a little bit.
And we have our 8:30 in the morning crosshairs here. Crosshairs are the vertical line that denotes the time that we start looking back to the left, okay? Right here, go to the left, we see here, this is our first low. So we mark that. And right in here, first to the left is here. We don't want to use this low by itself because it's inside of this candle. So I want to use the extreme. Where's the liquidity going to be? Is it going to be above this? Or is it going to be above that? It's going to be above this, okay? Why? Why not that one? And why this one? Keep looking left. What do you see over here? See that? These are relative equal highs. What does retail traders see that as? Resistance. So they see it going up to here, stopping, going lower. They see it going up to here, failing to go up here. So now they think this is a really strong resistance level. And it went lower. Look at that. Then the market showed how that level is real resistance by going right through it. But this would be a first target here to reach for. And if you want to use a longer term intraday,
This is a 15-minute of the previous chart. It's the daily. Out there real quick. Let's create that. Let's create that really quickly. So what is it again? 15-minute, right? How'd you bring it forward? Yeah, but I'm just running like that.
resistance.
So what's he using a high for?
Where's the to the left is here. We don't want to use this low by itself because it's inside of this candle. So I want to use the extreme. Where's the liquidity going to be? Is it going to be above this? Or is it going to be above that? It's going to be above this, okay? Why? Why not that
I
one?
understand why, but what's he using it for?
It's like running old highs, running out old lows, being a lot more nimble, and like a surgical strike. You take your handles or your points that you're trying to get out of the marketplace and then run. You don't try to overstay your welcome. So let's go down to a lower time frame. All right, so we have the 15-minute time frame, and we have our 8:30 in the morning crosshairs here. Crosshairs are the vertical line that denotes the time that we start looking back to the left, okay? Right here, go to the left, we see here, this is our first low. So we mark that. And right in here, first to the left is here. We don't want to use this low by itself because it's inside of this candle. So I want to use the extreme. Where's the liquidity going to be? It's going to be above this, or it's going to be above that? It's going to be above this. Okay. Why? Why not that one? And why this one?
Still not
Keep looking
understanding
left. Where's
why
the
he's
first?
referencing this.
All right. So we have the 15-minute time frame, and we have our 8:30 in the morning crosshairs here. Crosshairs are the vertical line that denotes the time that we start looking back to the left. Okay. Right here, go to the left. We see here, this is our first low. So we mark that. And right in here, to the left is here. We don't want to use this low by itself because it's inside of this candle. So I want to use the extreme. Where's the liquidity going to be? It's going to be above this, or it's going to be above that? It's going to be above this. Okay. Why? Why not that one? And why this one? Keep looking left. What do you see over here? See that? These are relative equal highs. What does retail traders see that as? Resistance. So they see it going up to here, stopping going lower. They see it going up to here, failing to go up here. So now they think this is a really strong resistance level. And it went lower than that. Then the market showed how that level is real resistance by going right through it. But this will be our first target here to reach for. And if you want to use a longer term intraday, target would be back.
He's talking about it as a
Target would be back here. Because to here. Because to this one is this one, which essentially is the same. Then we have this one.
with that red line. We actually have to be quick because I realize I only have under an hour and the video is under an hour, so we got to be quick so that we don't overstay the welcome, so we don't take too long to finish. Wait, if I didn't fall asleep, it would have been so chilling. Is what it is. Create a line. It's gonna be a little bit long. You're joking. So I can't touch the red line. This is so stupid. Not American.
Here. Okay. So obviously with the benefit of hindsight, you can see that we traded below that low here. Then we reversed and started going higher. We took out this high here, which I traded this. I did not hold for this. Now the question is, why didn't you hold it for that one ICT? Well, if you look at the range from this high down to the low over here, that midpoint is just above this high, right? And you have this low imbalance right there. So what am I teaching you in this mentorship? I'm looking you on a live account, trust me, just hear me out. I bought and right up here, and I took it out on this candle here, on that high. Now I could have held it, but to do so would be painting the picture that you can do this and take down these types of trades all the time. When the reality is, you're going to require a lot more time to develop than you probably think it will require. One of the things that happens when I have students come under my tutelage is they have been fooled by listening to people talk about the left side of the chart all the time, and they can't actually do it on the right side. And it is useful in the beginning, but if that's all there ever is, and if your educator can't trade on the hard right edge of the chart, it kind of makes you feel, well, either a false sense of security or a false sense of confidence that quickly gets evaporated when you trade with a live account, or creates analysis paralysis. And I have a large body of students that are lumped into one of those categories. They've been utilizing some other concept or approach, or they call it SMC, smart money concepts, and they'll think to themselves that, this is what's going to have to happen in the chart, and it isn't, because they're lacking narrative. So one of the things that I'm teaching in this mentorship, in my paid mentorship, is how to view the marketplace from a narrative standpoint. What's the logic? Why should the market do what it's doing? It's not enough to see how low is taking out next to go higher, or high taking out next to go lower. There has to be some greater context behind it, and that's what I gave in the beginning of the video. Now on the 2-minute chart, why the 2-minute chart? Well, that's for your homework. You go through the 5-minute, the 4-minute, the 3-minute, the 2-minute, and the 1-minute chart. I'm going to utilize the 2-minute chart because this is what I was using today for my own analysis. Okay. All right, so you see how we had the old low here. We trade down below it, and this 10:04, I'm actually highlighting that candle right there. The reason why I'm using that candle's low and taking the screen capture there is I want you to see the low candle's price. Okay, so that's where your stop would have to be, just below that, maybe one tick. By going long in here, based on the logic, I'm going to start down on here. The market trades below the old low, trades below it, rallies above, but does it trade above the short-term high yet? No. Then it goes down once more, below the old low, but not below this low here. Then it turns and goes higher. What did I see in this chart that allowed me to go long in here? What did I see? Nothing. I didn't see anything in this particular chart. I saw it in the S&P. Before I leave this chart, I want you to think about how that high was around 14,620, and it was this candle here. I got on that one right there. Then it retraced a little bit, and then went higher, pressed into the ultimate longer-term high, sweeping the buy side there. Let's take a look at the S&P. S&P, similar situation here. High, that's the best case scenario for the day. This high here, that's where it could reach for. 830, we're right here. What's the point of expecting to go above that? Not much. We want to see some kind of a protraction. So the market, yes, it went above that short-term high and then went lower than that low, yes. But watch what happens. It trades below it, comes back up, and look at all the volatility and the sloppiness inside this area here. Then the market starts to rally. So the draw on liquidity is going to be here. It took out sell side here. So let's look inside this price action and see if there's any details that would lead to a run into that, we'll call it the 44.95 level, okay? So 2-minute chart, this is what I was using. The market trades below the old low, as we see here. I apologize for screenshot. I wish I would have had these things on it, but you can look at your 2-minute chart on TradingView and you'll see this a little bit more clear. I apologize. But this low candle, it's high. Then we have one candle up, the next candle's low. There's your fair value gap. That's the run in here. So we have displacement low and displacement high. Is there a market structure shift bullish? Yes. It trades up, above it. And you look for the fair value gap. Is there one in here? No. Anything in here? No. How about here? No, it's closed in. It doesn't move down here. But we have this. So we trade down into it here at 1036. That candle forms. That's a long in S&P. Now, compare that with this fair value gap in the S&P. We traded below the old low. We took sell side out. We have a shift in market structure on the S&P. These averages tend to move in tandem. So that means they generally move in the same direction. So I'm looking at the Dow, even though you don't see me trading it, I'm looking at it. It took out sell.
Okay, that's going to be good for 2 examples. So let me get this, the main. Oh, wait, let's try that again. Okay. Chart number 1. Let's try number 2.
this low candle, it's high. Then we have one candle up, the next candle's low. There's your fair value gap. That's the run in here. So we have displacement low and displacement high. Is there a market structure shift bullish? Yes. Trades up. Love it. And you look for the fair value gap. Is there one in here? No. Anything in here? No. How about here? No, it's closed in. It doesn't move down here. But we have this. So we trade down into it here. At 1036, that candle forms. That's a long in S&P. Now, compare that with this fair value gap in the S&P. We trade below the old low. We look sell side out. We have a shift in market structure on the S&P. These averages tend to move in tandem. So that means they generally move in the same direction. So I'm looking at the Dow, even though you don't see me trading it, I'm looking at it. I'm also looking at the S&P, even though I'm favoring the NASDAQ because its volatility and its movement is more than the S&P. Other traders might be fearful of the volatility and say, oh, I don't want to trade that, it's too fast for me. I am loving this because I know how to trade. I can work within the volatility because I know what I'm looking for. I know the signatures, the algorithm's going to play out. So until I get these signatures, I have to wait or put leaders into the marketplace, which is what I'm going to show you when I show you my live account results today. But at 1036, let's go back up to the NASDAQ. We don't see any fair value gap in there, do we? Nope. But we start to see NASDAQ turning. So I went in long in close proximity to this order block. Okay, I went in at 14,505. That's inside of this order block. So I'm trading close to it. Now, I promise I wasn't going to teach order blocks that much in this mentorship, and some of you have been leaving comments, oh, I'm not into this now because you're not teaching order blocks. Okay, go watch something else. I'm going to teach it the way I want to teach it. Okay, it works, and you have to get yourself acclimated to how I'm teaching it, or don't watch. Okay, I don't mean to be rude, but I'm not taking suggestions on how to teach you. So if we are expecting a fair value gap to be a launching point for the S&P, and these markets generally move in tandem, I don't need the fair value gap in the NASDAQ because I'm utilizing the S&P as my indicator. What did I just say? The word that should not be spoken. Indicators, yeah. Even though I don't have them plastered all over my charts like graffiti, you can see the candlesticks in my charts. You can see the logic. You can see how the markets run for liquidity. There's nothing hiding or masquerading price. You can see it. It's clear. You need that. You need to be able to read the story of price and not the story of indicators. So the logic is that S&P low in here was trading down into an old fair value gap over here. It is pricing, but there is no fair value gap in the NASDAQ. See that? Now let's go back down into the S&P. Even my own pay memberships. Learning something tonight. I should charge money for this one. Oh, ICT. Fair value gap. Trade down into it there. That's a long for S&P, but I don't want to trade the S&P. So I'm going to use the timing of that candle for my long entry on NASDAQ. Trading what's not in the chart. Hint, hint. Nudge, nudge. So
I might switch keyboards because this one's so slow.
market rallies, and it trades into that short-term high that was seen on this go back up right here. So again, just roughing it around that 44.96, 44.90, what was it called, 96, 44.96. And that would be right in here. Bang. Hits it, sweeps it, accumulates some more and rallies higher, taking out that longer term hold high. All right. What gave me the confidence that this was turning here? Well, let's take a look at the three averages together. If you look at how the market's trading low here, on the Dow, this top chart is the Dow futures. The NASDAQ futures is in the middle, and the S&P is in the lower end here. So it's Dow, NASDAQ, S&P. During that decline in the NASDAQ and the S&P, look what the Dow's doing. It's saying, nah, I'm going to sit this one out, boys. It's not willing to make that lower low. Where NASDAQ did, S&P did. When you see that right there, and here's an important thing, you anticipated already. You're not looking for this. This is what some of my students, when they come to my mentorship, they see this pattern, they think, oh, it's diverging, so it means it's going to go the direction. No, this is something that confirms an idea that you had already established before price does what it's doing real time. What does that mean? You're already looking for a reason to go higher. So that means you're looking at an old low. Does it trade below old low? Okay. Does it have a shift in market structure that's bullish? Yes, we saw that in the S&P, but we did not see it in NASDAQ. No evidence whatsoever was in NASDAQ this morning with what I'm teaching you. But it was. Listen, it was in the S&P. And no, I don't trade the Dow, but I utilize it like an indicator. It's not plastered all over my chart. I'm referring to it because I have multiple monitors. I'm looking at my screens. I have a screen that shows charts like this. So I'm looking at the relationship of all three averages stacked over top of one another. And if I'm looking at a period of time and an area in price action that maybe is going under accumulation for long positions, this is what I'm looking for. I'm looking for that little fingerprint of the algorithm. What this is indicating is the Dow's unwilling to go lower than that low. That tips off individuals are looking for cracks in correlation. Okay, correlation would be they're moving lower here, here, and here. But that correlation, where they move in tandem together, cracks here at a very important time. Right when the NASDAQ and the S&P are trading below fold up. I get questioned all the time. ICT, how do you know it's going to be a fake break below an old low and rally higher, or a fake break above an old high and go lower? which is what I dubbed a turtle soup. Now, that's not the same pattern that is taught in Linda Rasch and Mary Connor's book, Street Smarts, which is actually an excellent book. I have my own interpretation of that, which is very easy. It's simple. There isn't, like, I'm not going to teach you a pattern, go buy a book and support the authors. But the idea is I'm looking for runs above old highs to set up a short position if I have the opposite of this condition here, where maybe the Dow didn't make a higher high, where the S&P and NASDAQ did make a higher high. By itself, it doesn't mean anything. So many students over the years have simply went in there to set up a short position if I
I prefer the keyboard. I lied.
I have my Rasch and Mary Connor's book, Street Smarts, which is
He was referencing another one, but he did say it wasn't that great, but he did take something from it. I'll get a screenshot so I can see what I'm talking about.
actually an excellent book. I have my own interpretation of that, which is very easy. It's simple. There isn't, like, I'm not going to teach you how to go buy a book and support the authors. But the idea is I'm looking for runs above old highs to set up a short position if I have the opposite of this condition here, where maybe the Dow didn't make a higher high, where the S&P and NASDAQ did make a higher high. By itself, it doesn't mean anything. So many students over the years have simply went in and said, oh, this is magic. I'm going to go just do that. And I unwillingly did the same thing when I first started observing it. I'm like, well, I don't need to do anything else. Look for this. And it didn't work out well. Okay, I blew accounts. Yes, I'm not ashamed to say it. In the 90s, I blew accounts doing this very thing here, just looking for these divergences. And then I later learned that I have to have some kind of narrative as to why this would even form. And to be honest with you, I don't personally need to see this because I know what I'm looking for. I already know that it's going to create this divergence at the times I'm trying to buy. But as a developing student, you may not have that experience, and there's nothing wrong with that. You may be trading longer than me. Maybe you've been trading 31 years, there's nothing wrong with that. Maybe you don't need this either. But for a developing student, someone that doesn't have a affinity for reading price action naked and not using indicators, these are the best indicators you're ever going to have. You don't need moving averages. You don't need stochastic. You don't need Fibonacci. You don't need any of that stuff. Okay, you don't need it. The only reason I'm pulling a fib up is to show you where the midpoint is. Have you noticed that? We haven't even talked about optimal trade entry. None of that stuff. I've stripped this down to the chrome. And it's beautiful, is it not? It's easy. It's so simple. It better be easy enough for my daughter to do it. Because if you can't do this one, I don't have anything for it. But nonetheless, I want you to think about how this pattern confirms the accumulation of long positions. Now, let me correct those of you that are going to take this information, run out there and create your own videos or your own little courses or your own little mentorships, okay? Because if you don't do this right, you're going to hurt the people that are listening to you. And I just don't want them to get hurt because of your lack of understanding what's going on. The Dow is not going down because buyers are coming in. That's not what's happening here. That's what authors and book writers and people that don't really trade or code algorithms will have you believe. This is an unwillingness to deliver to that low. This is a macro. A macro is something inside an algorithm that prevents or enables delivery. Delivery of what? Price. So the Dow is unwilling to go lower here. Okay, by itself means nothing. Does it happen at the same time that the NASDAQ went lower? Yes. At the same time that S&P went lower than that low? Yes. Okay, so let's go back. Here's that old low prior to 8:30. Remember, algorithms run on time and price, not price and time. Multi-level markers. The low, that's the price, yeah, but you have to refer to time first. What's the important factor of time? 8:30, go to the left. What's the first low? Right there, boom. So there's liquidity below that. It trades below it here. Then wait. Do we get a signal that allows us to hunt what I'm teaching in this mentorship? There's a swing high. It breaks it there. So now market structure shifted bullish. Look back through this price leg. There's your fair value gap. Oh, but what happens if it goes down there and it keeps on going? That's what your stop is for. Remember what I said earlier in the video? Some of you are so new. Okay, your infancy as a speculator and trader it's getting in the way of sound logic, because what you're thinking is there's a way for you to trade and never take a loss. There's a way for you to somehow, and this is nowhere near true, that you can enter the market and your stop never needs to be placed because you're right. Because what you're saying is, I'm afraid to be wrong. That's a psychological barrier that you need to get over, because I'm going to show you my live account, and there's going to be some negative numbers there. Those negative numbers sometimes are premium payments for me to get more intel. Okay, and with that, let's go into the continuation of this. All right, so here is my live account, and I did some trades this morning. I got to my desk a little late this morning. Couldn't focus. I had some expectations. I wanted to see it go lower. I told my paid membership last night that I'd prefer a move lower. We got a really sloppy opening, which is really characteristic of the 9:30 opening. A lot of people tell you, don't trade the 9:30 opening. That's scary. It's too much volatility. I actually don't mind it because I'm actually putting sometimes a order in to get a feel for what it's doing. Now, right away, if I just show you this chart and don't give you the context behind it, you're going to hear people are going to take my video and they're going to do all this armchair quarterback after the fact. It's never been traded by them. They're not doing a live account. They're always playing demo accounts, blowing demo accounts. They always have something negative to say about everybody else, but they're not doing anything themselves. Here's the context that's important, okay? Back in the 90s, I learned a lot of things from a floor trader that actually traded the S&P on the floor. I also picked up more insights from Larry Williams about trading the S&P and also George Engel. Now, George Engel had a really interesting concept. When I first heard about it, I kind of immediately discounted it. I was like, that's stupid. And what is it? Well, on the floor, sometimes traders would have just a disconnect. They wouldn't have a read on what heard about it. I kind of immediately discounted it. I was like, that's stupid. Just for themselves. Here's the context that's important, okay? Back in the 90s, I learned a lot of things from a floor trader that actually traded the S&P on the floor. I also picked up more insights from Larry Williams about trading the S&P and also George Engel. Now, George Engel had a really interesting concept. When I first heard about it, I kind of immediately discounted it. I was like, that's stupid. And what is it? Well, on the floor, sometimes traders would have just a disconnect. They wouldn't have a read on what the price is doing. So what they would do, not just George, but everybody on the floor would generally try to do this as well. They would simply go in and buy or sell short one contract and just see what happens. Now, for someone that doesn't know what trading's like, never traded with live money, or just now learning, that's going to be like, that's stupid. If you don't know what you're doing, why would you put an order in? Well, if you want to know how the market's likely to deliver, put some skin in the race. You'll have a greater feel for what it's doing when you put an order in. It doesn't need to be a large order. I'm only putting one contract in. I can only trade one contract because of the equity I have in the account. It's like $21,000+ to do one NASDAQ contract. And it's justified because of the volatility. You could be up or down $5,000 in a session. So, discount brokers are not a saving grace. So I put an order in 2 times. I got to my desk late. I wanted to dial in. And the surest way for me to do that is just to toss a contract in. Now, when I do that, I'm trying to read what the price is doing against that order. I'm not trying to pick a spot when I'm tossing that in there either. Now, I understand how someone that would never have had any experience trading with real money would look at that and say, that's dumb. Like, that's somebody that doesn't know what they're doing. No, you have no idea the benefits of having that. It's like dropping a hook in water that you've never fished in. You just test it. See, am I getting any bites here? If I throw a short order in or if I throw a long order in, I'm getting a feel for what the market's doing once that order's in there. And I'm reading the reactions. I'm not looking at the equity. Okay, I'm not trying to get a tug of war sensation internally of making money, losing money. I'm watching how price delivers around that order. Is it easily moving away from that order? Or is it lethargically moving away? Or is it completely running against it? That immediate feedback, that feedback loop that it gives you as a trader, because you have something in there that's worth something, you're going to be more attentive to what price is doing and what you're familiar with reading price than if you were just watching the charts paint the candles. And it's something that is true when it comes to like learning with a demo account. This is the limitations of learning with a demo, because you can test the waters, okay, by throwing in a single contract. And if that contract is basically, ran over, for lack of a better term, then you know that your bias probably isn't in alignment with that order. So if I'm trying to hunt the bigger move of the day, I will sacrifice these initial little runs. I'm not doing it all the time. Remember where we started this video? We're in the middle of that range on the daily chart. So technically, it can go either side of the range and take liquidity. I don't know when I'm going to sleep at nighttime, and also when I'm doing videos earlier in the evening, I don't know where price is going to be at 9:30 in the morning New York time the next day. I don't know that. No one knows that. Okay, no one's going to know that. So when I build a trading plan or idea around what I would prefer to see, I'm only looking for that the night before. Everything changes when we walk up to that 8:30, vertical line that gets put on my chart to show you. Now, based on those ideas and the relationship of the information I'm getting with that initial contract going in at the opening at 9:30, I'm getting a read on price. Sometimes these trades pan out and it's profitable. That's not the point. And sometimes it creates a small drawdown on the account. That small drawdown, if you count that as a skill thing, you're missing the point entirely. Okay? If you can get yourself and avail yourself some writings by George Engel, invariably you're going to hear him or read him suggesting he's done this. And floor traders did it as well. When I started implementing it, and I've done this with Forex too, sometimes my students will tell you, if we were all in a big stadium, okay, and we're all like saying, raise your hand if I said this or if I did not say that. They'll all raise their hand when I say, sometimes I'll do this with Forex. I just want to know what it's doing. I need more information. And there's no better feedback loop than to put something at risk in the marketplace, because you don't have anything at risk with a demo. You can put a trade on with a demo, but you're not really feeling anything from that. You're only really drawing a connection when it's right. When it's wrong, it's just like, well, whatever.
Okay, we'll make a note of that.
I would never take that trade anyway. So it's important to know the context here, okay? With that aside, let's move forward. So these are me putting in a leader in the market just to see if I can get a better read. Even though I want to see it going lower, I'm not so sure with all this back and forth movement. I don't know if it wants to run higher for reach for a higher form of buy-side liquidity, or if it's going to run lower for that low. So I tossed in two orders, and you can see them when I show you the history in my next slide. But all this went away, and then here's where I went short here, and I covered basically, then I went long, right on that candle right there. And what was my price? 14,505.5, okay? And I closed above that high. Remember the high was at 14,620? Here it is, 14,622 and 3/4. So that's 117 handles. I don't care about these little Mickey Mouse moves back here because that is a premium for Intel. I'm going to make a small investment to get a better read on these types of moves here, okay? If I show you these types of charts, or I make them available on the internet with no context behind them whatsoever, none, they would be trolled all day long, and they would beat their chest and feel smart like they're saying something that means something. They have no idea. They have no reason to think that anything they're saying is valid or true. But I'm showing you the logic here, okay? This is not latency, okay? When I was doing latency tests, that is me testing the feedback timing from putting the trade in, how fast I can put orders in, what type of slippage I'm getting, because I have an algorithm. And that timing is important for me because this account won't stay at one contract. It'll eventually grow so I can do more. So I need to know how fast I can ramp it up, or is it going to take me a little bit longer term time frame to build it up before I can start pressing it harder. Everything I'm showing you in this account is all one mini contract basis, not more than one, just one, because of the leverage and the limitations of margin. It prevents me from doing so, okay? As you can see, it's $37,823.15. And those trades that I showed you on the chart, here is that history, or whatever somebody was posting, show us the history. You know, it's not a live account unless you can show this area here. Well, here's the trades I've taken for today. Here was the initial trade here. Okay, you might look at this and say, oh man, I wouldn't do that. Pay $750. I'm looking for significant price moves. I'm looking at trades that are a little bit more significant intraday because that's the model I'm teaching you. Now, I can teach you a very high frequency type trading style that literally will blow the doors and beat the brakes off of all these supposed algorithms that YouTube's promoting. And they won't have these types of trades in them. Okay, it'll be just real clean, like $500 runs or $300 runs on equity, and then you get in and get out on one contract. So as you build this up, 10 contracts, it'll be easy for you to do $3,000, $5,000 a day. If you take the results I'm showing here, these are the trade results. These are my 2 leaders I put in. Okay, and I got a better feel for what the price was going to do. Now I took the trade here. This one here, once we got closer to the actual setup around 10:30, 10:36 candle, these again, I was testing whether or not that there's going to be a run. Now I'm sacrificing this and a little bit more of my starting equity to get that information because I know if I get the right intel, I know if I'm buying, okay, I'm going to be buying. Then I'm going to look at the S&P like I showed you tonight. The pattern, the setup. Remember what I was telling you at the beginning of this mentorship? This pattern forms every single day, but you have to look for it. It may not be in your asset. It may not be in your particular market, but it exists. All of these markets move like boats in high tide and low tide. All boats rise in high tide. All boats drop in lower with low tide. So I'm trying to get a read on this environment as a whole, not just my own asset class. Since I'm trading the NASDAQ, I'm not limiting my view or analysis to just NASDAQ. There has to be some intermarket relationships. Okay, and I'm combining markets that I'm not even trading, like the Dow and the S&P, but I'm using the feedback that they're providing me in terms of intermarket relationships. So that's what I taught you tonight, intermarket relationships and using the consolidation hurdles. When you have a consolidation, what do you do? Well, this is what I do. I'll throw a contract in there to see what it's doing, and I'll get a feel for that. I don't care about drawdown because I'm comfortable. I can go in and fix a drawdown. At the end of the year, you're going to see that every single day in here, there's drawdown, and I correct it. My goal is no losing days. Now, that's not something that you should have as a goal coming out of the gates as a new student. I'm not saying that you're ever going to get to that point, and I do have losing days, but I'm not showing losing days predominantly. If I have a losing day here or there, it's probably been 2 since the start of this account. I fixed the drawdown. I know how to do that. So when I was doing latency tests, and I'm testing TD Ameritrade speed and how they can deal with my positions when I'm getting in, I'm getting a read on how fast they can fill me, what type of slippage I'm having, because when you start doing lots of contracts, that's going to mean a whole lot more than just one contract. But one contract, as you can see here, I want to say this real quick and get out of the way. The profits and loss category right there, that little tab, it's at $13,927. That is not a lot of money, folks. It's not, but it's 51+% now in 2 weeks of trading. 2 weeks. Well, 2 weeks in today's not a day, so 2 weeks in 1 day. So 2 weeks, 1 day, 51%. Now, it's one contract. If I was trading with 10 contracts, we would be in some serious money then, right? You'd start paying more attention to it then, right? $13,000 minus $14,000 isn't that much money. But what happens if you start doing that every single month? I'm not suggesting that you can or will, or promising that you will, but what happens if you do? Could you make a living on that? I'm just asking. I put a poll on my community tab and I asked everyone that would read it. Is 20% a month return, is that a respectable rate of return? And if you look at the results, it's predominantly yes. The other answer was no, it's not enough for me. Now, there's a lot of trolls that, like the left wing, they'll put whatever the expected adverse choice would be. They'll choose that one, okay? But I'm sure there's some of you that think because your first, impression about trading is everybody gets rich and nobody loses money. And everybody gets Lamborghinis in the first 3 months and it's just great, nothing bad can happen. It's all up from here. And I've never been a mentor like that. Okay, I've had very nice flashy things, but I don't try to promote that idea. I teach you this is going to take a lot of work. But the work and the things that are real about this industry and how you're going to have to get, like I'm teaching you, like what causes me to get clarity? Because sometimes I don't have it. I don't know is something I say periodically. And not knowing something is not ignorance. It's not an absence of skill. It's honesty. And you have to be honest with yourself. You cannot assume that you're going to be coming into these markets being perfect. Because perfect is not something that exists in trading. It does not exist. There is never going to be someone that's perfect. You're in this industry to do what? Make money. That's it. If you're in here for any other reason, I'm here to impress my dad, impress my mom, my girlfriend, boyfriend, husband, whatever. Old gym teachers. That's the wrong reason. Because you're doing things from an emotional high. And when you have the emotional low, it really hurts. And you need to keep yourself focused on why you're doing this. You're doing it to make money, to improve your financial condition. Like I mentioned before I started this mentorship, I believe that there are hard times coming ahead. And you don't need to make $14,000 in 2 weeks. You don't need that. But if you make your car note for the month, or if you make 50% of your mortgage or rent payment every month with something like this, and I'm not saying or promising you can, but think like that. Let it evolve from that. When I was a young man, and I said that many times in my videos, and I have some people in this mentorship that are watching, they don't like when I do these types of rants and things. And I'll say, I'll stick to the topic, blah, blah, get to the point. This is the point, okay? Because if you're not trading live money right now and consistent, you're gonna have these things come up in your own thinking, and they're gonna be barriers. So when it happens, you're gonna be wanting to email me, okay? Or you're gonna wrestle with it and not know how to deal with it. But when I first started, back when I was 20 years old, I'm looking at the market thinking, if I can get to the point where I could save $1,000 a month, by the time I'm in my 40s, I won't need to work. No, obviously, I didn't factor in inflation and all that stuff, but $1 million by 40, that was enough for me to get to work and focus on learning how to do this. Contrast that with what you see on YouTube today. Follow my signal service, join my mentorship. I made $60,000 in one trade. Here's the proof. Here's the withdrawal. Here's this. Here's that. That is not something that is sustainable, and it's such a wild unicorn that just pops up once in a while. You don't see these people pulling out $60,000 consistently every single week. That's not happening. Okay, but I'm pulling out $6,000 a week consistently. Now that's not a lot of money. It's not. But I'm quite confident in saying that I think that the majority of you, and I'm talking the high 90% of you, could live pretty nice on $6,000 a week. Will the market continuously offer me $6,000? I don't know. I haven't traded indices in a long time, but I traded these markets 30 years ago. Okay, I know them. So I'm not scared of them. I'm not scared of the volatility. I love it. But if you look at the relationship of how these negative trades give me intel, they give me insight, because I'm trying to get a read on the next swing on that daily chart. These are all small little investments on me getting a better read on that. So you think that your trading account's never going to have any of these in them. When these are an informed trader, someone that's seasoned, that knows what they're doing, they'll invest in their own trading. Think about what I'm telling you. You're investing in yourself to get more information that you can't collect just by watching the price action. So you got to get a closer feel for it, and you invest and you put something in the marketplace. Now, there are trades, and I've mentioned this, I'm not sure which video it was in mentorship, but I did one, and they were losing trades. They were wrong ideas. They were absolutely wrong ideas. Not all of a losing trade record is errors. And that's why it's important, because if you just look at somebody's trading statements or their positions and their statements, that's not going to give you the context that would be required. Like, I could look at someone's statement and say, okay, yeah, they're making money, but in reality, unless I look at what they're doing on a chart, they could be lucky. They could be just getting lucky. And this today was me investing and trying to get a feel for what I think is going to happen in the next few days worth of data. And I'll throw in a couple trades where it doesn't matter to me if I'm losing. Sometimes when I do this, they're winning trades, but they're not meant to be winning trades or losing trades. It's just me getting a read on it. Now, when you do a micro account, okay, it wouldn't be this much money. And you may not trade with this style. I know many of my students don't do this because they just don't think it's a worthwhile investment. But those same traders that are under my tutelage are not capturing 100+ handle moves in these indices either. So it's a trade-off. Okay, what is you trying to do? What are you trying to accomplish? I'm not trying to get 10 handles, on a lot of contracts and scalp. Okay, I know what I'm looking for. And this tab over here where it says profit and losses, I don't care how much money I deposit in the account. The broker will never put that money in that tab. So when you read people making comments on the internet, and I have a few of them in the previous video that I mentioned and showed today where I was showing my live account logging into it and the whole show, they said that I'm adding money and this is reflecting the additions. And that just proves that these people have no idea what a live account looks like. They've never seen one in their life. No broker would ever reflect deposits in the profits and loss category. That would never happen. And this is absolutely profits. And an organization like the CFTC would literally come after me or anybody else. If that wasn't real money, I'd be breaking the law by saying it is real money. That's real profits right there. Okay. These trades here, I cleaned up all of this with that trade right there. Okay, but I want to give something that I think and believe that is realistic. My intentions are not to run this account up to $1 million because I don't think that you learning from this YouTube channel that is realistic. Can some of you do it? Well, the sky is not the limit. Okay, I'm on record many times saying that. I have students that do very well. I have students that don't make money at all. Now, you might be an exception. I don't know that. You may believe it. I don't know. Okay, but the things I'm teaching on this YouTube channel, I have faith in. That's the only thing I'm showing here. I'm not saying, look what I can do, so therefore you can do it too. I cannot promise you that you're going to get the same results. In fact, I'm promising you that you won't get the same results as me. Okay, but I try to trade this account with the expectation also that I don't want it to be consistently over and over again where it's just too good to be believable. Because I want you to be able to see these statements at the end of the year and look at them and refer to them and say, you know what? There's these times in the market in certain months and certain days where there was drawdown in this account and it came out of that drawdown and look where it ended for the year or look where it ended for each month. That is tangible, real world help. When you feel like if you have a losing streak or if you have losing trades and you look at someone that's been able to use the logic that I'm teaching you and still correct it. Now, I can correct the drawdown intraday because I know how to trade very well. I'm not bragging, it's just the facts. If I know what I'm looking for, whatever drawdown I have, and I can correct the intraday drawdown that I've had on the chart. If we look at how the market can give us these opportunities, and you can see that this trade here, there's that entry, 14,505 and a half right there. 14,622 and 3/4. Right here. That was the sell. That was the exit. Here's the commission cost. Here's the fees, and here's the commission that TD trade takes out. And here's the return on that one trade. $23.45. $2,345. That cancels out all of the leaders I put in to get a feel for it, and I pocketed $1,100 for one day for a short amount of time. I could have held it. I could have done that using what I'm teaching here. But I'm trying to teach by example, so that way you don't look at me do unrealistic things that you can't do right away. Do I believe someone that has put a year into trading and studying what I'm doing with this mentorship can trade like this? I personally believe yes. But does that mean that you are all going to do it? No. If I didn't believe you could do it, I wouldn't be up here doing it. Okay. The logic is being shown to you. I showed you in the charts how I use the S&P to time my NASDAQ trade, and here are the actual history. This is it. Okay, and I asked that they show this. Okay, here it is. Do the numbers here, add them up, and then add to that profit, and look at the video I just posted today. And some of you can say, oh, this is Photoshopped. Photoshopped because it's on your PowerPoint. I do PowerPoint because I'm not having to worry about hiding my user number. Because if I hide that, then you can't see all the details in here. I think it's what turns off, so I want to keep everything so you can see it. So it just allows me to not worry about it. But nonetheless, I want you to think about how daily bias is not an everyday bias that's going to work in your favor. Some days I go in, I'm expecting like last night, I preferred to see the market go a little bit lower, and it didn't deliver. So I had to make adjustments. And then I caught myself on the right side of the daily range, exiting where I teach you, getting in where I teach you. Right there, there's logic. That's the proof. Okay. There will be days where I try to do this, and I'm going to have a losing day. It will happen. I will not be able to correct it. It will be a losing negative day. When that happens, the first instance that happens, I'm going to show you it. Okay. I'm not trying to hide the losing days, but the trader in me, the person that is ICT, I refuse. If I have the capability, I refuse to let my negative day stay negative at the close. Now, you might look at that as, oh well, you're you can't accept a losing trade and you're trading emotional. So that's nonsense. This is someone that's got 3 decades of experience, and I know how to fix it. So if you know how to fix it, wouldn't you do it? Right. So again, everybody's gonna have an opinion, and everybody's gonna have a way of thinking how they need to be taught. But I've been doing this for a very long time, and I'm not going to change my style. So the order of which I'm teaching it, the topics I'm talking about, the way I'm showing it to you in the charts, that's how I'm trading. I'm putting the trades on based on that logic. So that way you can see, I have faith in this. You may not have faith in this. You may never take these trades. You may never ever put any effort into running. You're just watching this like it's a Netflix binge watching scenario. Okay, that's cool. But this is something that is transferable. I can do it. It will repeat. To answer your questions, I'm getting a lot of comments also, and I'm going to close the video here. The algorithms are not going to change because ICT is teaching you how to navigate with them. Period. Why am I trading these markets when I'm supposed to be the Forex guru? Well, if you look at Forex is going real quiet. It's sideways. So I'm going to trade this market. Also, as a compare and contrast, I've been doing this market a lot longer than Forex. Again, I started with these markets here and bonds, which when we get into May and June, I'll probably trade some bonds in here as well. I'll give you some tips on how that market works a little bit too. But hopefully you got something from this. I was a little all over the place, but I wanted to be relaxed and communicate a lot of things that were coming to me by way of the comment section. I appreciate all your comments. I appreciate all of the feedback you guys are giving me. Just so you know, I know some of you are probably leaving these sweet sugar rush comments and really lavishing me with adoration. I'm not trying to put those comments. I always accept one comment for each video as a way of saying I like your comment. I think that's a significant comment that I think the community would appreciate, not just always just loving ICT. I appreciate all that, but just know that those types of comments are never going to be allowed to be shown. I'm holding all the comments for review because I still have some terrible things being said to me that are not true, and I'm not going to get a stage for that. Okay. In closing, if anybody out there says that they're doing trades that are live and making $20,000 a day or whatever, and they're not doing it in a simulator, let them show you by logging into their live account and doing it like this. I'd be interested to see that also. Until next time, be safe.
I think we might have time for episode 8. Nah, it's kind of close. I do want to have a shower. Okay, we'll do. I mean, episode 8 is the same as, like, we can add it to anything else. So we're gonna try and do it today. But what we'll do is, I'll probably just episode 8 and 9 minimum tomorrow. We might even do it when we come back. I'm going to church, so I'll probably be back around 4 hours from now. If depending on what I want to do in the evening, I may be tired. I might have to cook. I don't know yet. But I'll probably, the next video, if it's today or tomorrow, will be this. I know I've said today or tomorrow a lot, and it's always been tomorrow. But yeah. Oh, he's going to Forex in episode 8. Ooh. Okay, cool. That's going to be very interesting. So yeah, I mean, we finished episode 7 now. But we'll check. Should say episode 7, right? Yeah. Going to be on to episode 8. Today is the 10th. We have 33 more. And we're trying to do that in 20 days. We're going to have to start at some point doing 2 episodes. To be fair, around episode 23, we have 2 long ones. But then from then onwards, 14 minutes, 23 minutes, 2 minutes, 17 minutes, 12 minutes, 9 minutes, 19 minutes, 16 minutes, 18 minutes, 16 minutes, 9 minutes, 24 minutes. All of these are under like 30 minutes. And there's like almost 10 episodes of that. So that will be very quick, which is why I say we can easily finish it at the end of the month. So next episode 13, 27 in an hour long video, 29 hour long, 46, 4 minutes, 9 minutes, hour long, 20 minutes, hour long, 2 hours long, whatever. Well, this is going to be interesting. 2 hours. Damn. Cool. All right. Anyway, it's been your boy CJIC. Thank you guys for tuning in, watching us back. We are going to be seeing you guys tomorrow for the episode 40, what's the number? 45, I think it's tomorrow. 46, 45. Anyway, it's been your boy CJIC today. CJIC, we learned a lot today. And thank you guys once again. See you guys tomorrow.